We are back with another exciting episode. Today's episode, man, this is going to be really good. Really excited. It's going to be a bite-sized episode. I wanted to share a couple of these with you. It's a busy season with the holidays. We got kids' birthdays. We got Easter. We got family coming in. All types of stuff. So, with that said, I wanted to record some short episodes that will really compound for you, that I think they're just so important and they're missed. And that's what I want to do for you today. Is I want to be the trusted financial voice in the fitness industry. This is powerful, powerful stuff. We're talking about the core four, and I'm just going to riff on the core four, which these are the most important numbers. There's so many numbers. There's sales, expenses, net income, there's gross profit, there's revenue per team member. I mean, the list goes on and on and on. And what happens when you have all those numbers? We end up not tracking anything. And I've worked with startup businesses, just getting going, starting their gym, and I've worked with multi-million-dollar operations. And this holds true regardless of the level of business, even in other industries. If you're listening and you have a different type of business, these. Well, I should say this is specific for the fitness industry, but I would say at least three of them are definitely going to be in the core four for any business. One of them is a little more specific. With that said, take a second and let's see if you can guess what the core four are, and shoot me a message and let me know if you were correct. So you could pause it or just take some time, jot down what you think I'm going to say. These are the core four financial numbers that you want to be looking at like a hawk. We spend a lot of time making sure that we have a grasp on these with our CFO clients. Some people make the mistake and they think it's too simple, but the truth is, if the average business were to just be hyper-focused on these four, then really good things would happen, especially over time. Don't get caught up in the hoopla that there's all this special information that you need to do. Yeah, sometimes we want to add things and we do that over time, but get consistent with this. If you don't know all of these, then shame on you. No, if you don't know all of these within like 2 minutes, then we got an issue and we need to solve that. And if you need help with that, reach out to me. I could point you in the right direction. Would love to see if it might be a good fit for us to work together or not through the various services that we offer here at Fit Profit Solutions. But let's get started. The first one is not going to shock you. We're talking about total sales. Total sales, also just known as revenue. This is the money that's coming into your business over a period of time. We want to track this pretty frequently. It's a lag measure, right? It's something that happens as a result of other things, your sales appointments, your lead generation, and all those things. But if we could track this regularly, we can see the trend. We can see what we need to course correct, depending on how we're doing. If we're on schedule, off schedule, right ahead of schedule, we can make decisions accordingly. We want to track these things. I would say for all of these that I'm going to talk about, a good rhythm to start with is once a month. If you're listening to this and it's the middle of a month, you should know these at least for the previous month because that month has been completed. Some of these you want to keep even more consistent track of. Maybe it's weekly, maybe it's daily, and that would not be a bad thing. But total sales and total revenue, that's what's known as the top line. That's what's coming in to your business. It's the result of the sales that you've made. It could be from your various memberships. It could be from supplements. It could be from coaching that you do in addition to your core service. Whatever you're bringing in, that is your total sales. That's going to be, of course, a combination of your EFT or your automated revenue, as well as any other one-offs. And I think I shared this in a recent episode. There are some people that teach it's all about the EFT, And I subscribe to that to a large extent. I think that's powerful, right? It's amazing if you can run your business and have all your expenses covered with your EFT. That's really awesome. But don't sleep on some of this other stuff. I remember in my gym ownership, in my glory days, I remember doing really well with EFT, but then also a few times a year having monster sales months because we did some kind of challenge or something. And yeah, that's real money, and that really helps with hitting your financial goals. So I would say, yeah, you want to pay attention to all of it. You want to make sure that you are setting goals there. We talked about that in a previous episode, how to set sales goals. You're tracking against them. You're recording your sales daily. Every day, somebody needs to make a sale. So make sure you know your sales. There's different types of accounting. There's cash basis and accrual basis. And if in this case, we're talking about cash basis. So if you're confused, like what does that mean? Because you might look at your report. Let's say you use Zen Planner or MindBody or PushPress or one of the others. You'll find that number doesn't always match. Why does my report say that I made $32,000? Or maybe it's even Stripe. If you're using Stripe, I use Stripe for billing, and look at my Stripe report, and it doesn't always match the number that hit my bank. And why is that? And the main reason is there's 2 or 3 reasons actually, but for the most part, it's timing, because it's March 30th and a sale went through. That's going to show in your software, but that money's not going to show in your bank because it's going to take a few days to hit, depending on the schedule. Some of them are like, I was talking to one client, it was like a week lag. So if she makes a $1,000 sale today, that money doesn't show up in her bank until like a week later. She actually was able to make some changes there that could help from a cash flow perspective, which we will talk about. There's also fees associated sometimes, and it depends on if those fees, like with Stripe, they take the fees first. So when you make if you make a $1,000 sale, it's going to show as $1,000, but you don't get $1,000 because they take their fee out first. That does need to be reported properly in your books, which a lot of people are not doing. But nonetheless, it is a reason for the discrepancy. And then there might be some other issues, whether that's other fees or chargebacks. But total sales revenue is number 1 of our core 4. The next one, number 2, is net income, also known as net profit. Most of these numbers have different terms that people use, so I want to make that clear to you as well. But net income or net profit, that is going to be, the formula for that is your total sales. Again, if we're talking cash basis, that's the total sales that hit your bank minus the total expenses. And where people go wrong sometimes here is they don't have their expenses done properly. They have some things that shouldn't be expenses that are expensed, and they have other things that should be that are but shouldn't, or vice versa, and it throws numbers off. So that's why I want to make sure that our books are really clean and the things that are on there are actually business expenses. So everything on there, and it should be legitimate. And I don't only mean from an ethical standpoint, like I probably shouldn't include my baby's formula as a business expense, right? That's probably not a good idea. But also just things to know, like what are, even if it's things for your business. I make a loan payment, I make a credit card payment, I do my payroll, whatever that is. We want to make sure that it's entered properly. Something that we spend a lot of time doing. Make sure things are done properly. Yes, so that you stay out of trouble, but more just as important, so that you know where you're at and you can make clearer decisions with that. What should these numbers be? Like how much should your total sales be? We talked about how to set those goals. There's not necessarily a target number that you quote unquote should be at. I mean, of course, ideally you're able to pay all of your expenses. You're able to pay yourself. You're able to have something left over. A lot of that depends on your goals and your lifestyle and the risk that you carry. And depending on, I have clients that make $80,000 in profit, and they are really happy because that covers everything. They have some margin, they're saving. maybe there's a spouse that's bringing in some income as well. I have others that are making a lot more than that, and it just there's no set number. It's really you determining what you want to bring in. There's this whole thing about total sales versus profit and what's more important. Of course, the profit is what matters because that's what's left after the expenses. A lot of people get so caught up in the gross. I heard someone tell me recently that I just want to hit $1 million. But that's not the only factor. Like hitting $1 million is fine, but it's very likely for somebody that's looking to hit $1 million to not be doing as well financially if you look at the whole picture as somebody that's bringing in less total sales. And there's lots of reasons why that could be. It could be because of debt. It could be because of higher expenses, more payroll, more headache. It could be a lot of reasons. It doesn't mean that you can't have a really great business making a lot of sales, but we just want to be careful just looking at only one metric. So again, just to recap, we're looking at the total sales. That's core for number one. Core for number two is your net income or net profit, also known as the bottom line. It's what's left. Take what came in and everything goes out in terms of expenses, not what goes out of your business, but what goes out. These first two numbers are financial statement numbers. They're accounting statement numbers. These are going to be on your financial. It's not what you think you spent or what the money that left your business. These are numbers that are pulled from your report. So net profit, we're going to just to give you a little clue for the next one. It does not equate what's in your bank. There's lots of reasons why it won't. But you want to look at that. It's really an important number. That can also be converted into a percentage. So it would just be taking the percentage of your gross or total sales and what percentage of that, just like really simple math. If you made $100,000 and $30,000 was left after expenses, that would be a 30% margin because you take $30,000 and you divide it into 100,000 and times that by 100 and you get your percentage. So that's the formula to do that. What's good? What should it be? And this one can be tricky because there's lots of factors that can affect both your net income and your profit margin. That's why it's so important to do all four of the core four. Any one of them by themselves can be very misleading. And I'll give you examples of how they can all be misleading. That's why when I hear stuff, I know at this point that it's not the full story. Whenever you hear anybody share one number about their business, it's not the full story. I can poke holes in any one number that people talk about. So they say, my sales were X. That's great, but it doesn't mean they actually made any money. Or they say my profit margin was 40%. That also doesn't necessarily mean a ton. It might depend on what their total sales were. It might depend on what their expenses were. It might depend on if and how much they paid themselves. So all of these numbers can be manipulated to a certain extent, but what you can't do is manipulate all four of them, because all four of them flow together really well, and then we can get the full. If I have these four numbers of your business, I can get a pretty good picture of your business as long as I know that they are accurate. And when it comes to the percentage of the net, it's called the net profit margin, or just profit margin. There's also something called gross profit margin, which is different, and that's actually not on my list, and that has to do with cost of goods, which many gyms either don't have or they don't have enough to make the core four. With that said, if you're in another industry, that's definitely on your core four because you really want to know how those costs of goods are affecting your overall business. But that's also another way for things to get thrown off track when you're dealing with that because, what's better? A business that has $1 million of sales, but 400,000 of those sales came from things they sold that they had to buy inventory for and have cost of goods associated with that. And that's the whole point of having the gross profit, so you can try to compare apples to apples. But as you can see, it's hard to do that, especially across different industries. But when it comes down to the net profit, what's a good number? I will try my best to give an answer for this, but it really is tough. If we could assume that the owner is paying themselves a reasonable wage, which is a whole nother argument, like what is a reasonable wage? But if you just use some mental integrity and you say, yeah, if I had to pay somebody to do everything I do in the business, to do all the sales, the marketing, the visioneering, the team leadership, the sessions that I'm doing, if that's the case, and then you subtract that from your from the sales, right? Take that number out. Then we could look at some margin percentages and see how we're doing. And one thing, like one of my last CPA told me that I think is great advice. And what's a good? This is not going to sound super sexy, but what's a good profit margin? Like anything above 0 means that you potentially are not losing money. You again, this is hard stuff because you can still be losing money with a positive profit margin, but it's showing you that you're at least on the right side of the equation. If we're looking at business in general and we're comparing apples to apples, 10 to 15%, that's after all expenses, including the reasonable salary for the owner, is considered healthy, mostly. Again, there's different standards for different industries. Our industry doesn't really have that because of these other factors. Anybody that tells you we do have that, I would disagree, because we're just not apples to apples. There's even how your business is taxed will completely determine your profit margin, how you get paid and how your business gets taxed. But if we're assuming that you are taxed as an S corp, which many are, and you're taking a reasonable salary, then if you're 10% or higher, then that's pretty good. That means you have 10% left after everything is paid, including you. And I'm not talking about distributions that you need to live. So let's do some quick math here with my calculator. If the business it has 10% left. Let's say the business made, just picking a random number, $600,000, and they are 10% profitable, $60,000 over the course of the year, assuming there was no big debt payments. They'd have $60,000 in cash. Not so bad in that case. I just wanted to kind of show you an example of that. 15%, obviously, you'll see there'd be $90,000 in cash. So a business like that, a $600,000 business that is kicking off a healthy salary for the owner and has $90,000 bottom line at the end of the year, I would consider that really good, really strong, really healthy. Very few are actually doing that. So that might be a better target than hitting the 7 figures, if I'm honest, or at least hit that first and then go from there. The next one, so the third one, a little nuanced as well, is something I'm going to call net owner economic benefit, and we'll just call this the economic benefits of the owner, and I'll tell you exactly what it is so that you can start tracking it. This would be a combination of, and this is a term that is not like necessarily an official term, but it's something that you can use to compare apples to apples. Because some people, they throw out the word net owner benefit, but that's also not apples to apples, because some people they have a car and then the business is paying for it. Maybe it should, maybe it shouldn't. They have their family cell phone plan, and what are we including? What are we not including? I'm writing off part of my office at home, and there's my internet, and there's all these things that can skew that number. So for the sake of consistency, and you can track that, that's fine. But in this situation for the core 4, we're going to track the net owner economic benefit, which would be a combination of your W-2 salary, and that it would include the employer part of the taxes for that, and that would also we would also include any other I guess you would say, profit at that point, which theoretically could be used as a distribution. And the reason why I will call it profit is because if we just use the amount you're taking as a distribution, then that also throws it off, right? Because you could take more, you could take less, but you can't really argue what the profit was. You had profit, and you're adding that to your salary. And the only other thing I would add is if you are doing contributions to your retirement plan, and they're coming through your business, like employer contributions, because that's direct economic benefit. You could have chosen not to do that and just paid yourself that, or had more profit. I think that covers that. That's a good way for you to stay true across the board with what you're tracking. It's just, again, a good number. I would consider that part of the core four, because that's really how you are directly benefiting financially from the business. Is that the be all end all? Not necessarily, because even in that case with that profit, you can't necessarily use it all, because some of it you're going to keep to maybe invest in the business. Maybe you're going to use it for I don't know, opportunities, or just some extra cash in your business. But it's a good consistent number to track. And then finally, this might be the most important, because there's a rule in business that says if you run out of cash, you go out of business. So we're talking about your cash, and we can keep this one really simple. It's just the cash in your bank accounts for your business. These all have so many different nuances to them, because sometimes I will potentially pull cash out of my business because maybe I don't need it, and that's going to lower the number. Is that worse? Not necessarily, because I'm using it for another financial goal that I have. So you just have to keep all of these things in perspective. I do encourage you to look at your cash versus your liabilities, and if you there's different standards for that. But if you, like, for example, have more current liabilities, essentially you owe more money than you have, you're in a danger area or danger zone, because that by nature means that you can't cover what you owe, right? The good news is you don't usually have to cover it all in one shot, but you never know what can happen, as we've seen before. So you want to pay attention to that. So let me recap all four of these numbers. And my goal when I started recording this was to keep this really simple for you. And if I'm honest, I fear that I kind of made it a little more complicated than I needed to. So I apologize for that. I hope you will forgive me. I want to know what you think of this. I want to know if you know these numbers. I want to know if you have any questions. Please reach out to me. I'm here for you. But this is really important. So the first one is total sales or total revenue. The next one is net income or net profit, which also can be expressed as a percentage, your net profit margin. The third one is what we call the net owner economic benefit. That was the financial benefit to you as the owner. And then finally, there is your total cash position. So that number should be properly expressed from on your balance sheet. That's where you would pull that. You also can just see what's in your banks, but you want to also have your balance sheet updated properly. Those are the core four. If you haven't been tracking all of those each and every month, that would be your action step. I'll give you a little bit of a plan here. So I'll make up for any confusion that I cause and give you a 3-step action plan so that you can get on top of this stuff. So step number 1, you're going to kind of rate yourself. Okay, how am I doing in knowing these numbers? Can I easily pull these numbers if I just have a couple of minutes? The cash that I have, the net owner economic benefit, the net income, and the total sales. Can I pull that easily? That's step number 1. Step number 2, what do I need to get in place to make sure that I'm able to get these numbers? What does that look like? Do I need to update my bookkeeping? Do I need to get a new bookkeeper? Do I need more visibility there? Do I need to have a spreadsheet? Because net owner economic benefit, for example, is not necessarily going to be on your financial statement, right? But it's really important. So how am I going to look at that? And then the last piece of your 3-step plan is to start implementing, start tracking. And I want you to do that for at least 3 months before you make any adjustments. And then you see how that affects your decision making, how it gives you more clarity, more awareness of what you need to do. I really hope this helps. And I know I'm a little nerdy, but this stuff matters especially over time. This will keep you in business. It'll keep you going strong. It'll help you making an even greater impact in your community and in your facility, and it will help you grow. So thanks so much for listening. If you know anybody else who might benefit from the Core 4, please share this with them. Share their information with me, and I'll help them as much as I can. And please leave a review. And until next time, you're listening to the Your Fitness Money Coach podcast.